Venture is not a field for anyone who doesn't have sort of a learning, a growth mindset and a desire to dig in and learn, because everything's different. Every time you turn around, there's something new and interesting and different you get to learn. And I think it's pretty challenging to invest in hardware companies if you don't have some appreciation for what it takes to build a hardware company or a hardware business. Assuming Chris Wright gets confirmed, oh yeah, he's a huge energy guy. He's a pragmatic energy guy. He's like, let's do the thing that makes sense.
Hey everyone, quick note for you. You're currently listening to the free preview of this episode. If you'd like the full thing, the full shebang, go over to our Substack. That's cleantechies.substack.com/subscribe and become a paid subscriber. Any paid subscription gets you full access to the show on the Clean Techies Substack.
We are kicking off 2025 with a real treat for you. We have one of the most prolific ClimateTech VCs joining us for our first episode of the year. Joshua Posamentier, I might be pronouncing that wrong, but hopefully I got it right. He is the co-founder and managing partner of Congruent Ventures, an early-stage venture capital fund focused exclusively on climate tech. Now, if you're in climate tech, you're likely to have heard of Congruent Ventures before, but a little bit more about Josh. With a background in physics and his career starting in the semiconductor industry, actually, he transitioned into climate tech investing and held various roles at Intel and Prelude. He is widely considered, not just by us, but by all of his peers, as an OG in this space. He's been tackling climate tech investing, ever since before this current wave of interest. He has deep technical expertise. He's been investing for over a decade, and that's given him a unique perspective on the sector. And you can hear that in how he talks about profit, returns, and finding those pockets of innovation that matter. One of which includes battery storage and long-term duration energy storage that we talk about as sort of a hotbed of potential innovation. Now, a little bit more about Congruent. Congruent Ventures is an early stage climate tech fund based in SF, and they invest in a wide range within climate tech. They've made over 60 investments into companies, and they're very known for their hands-on approach and staying actively involved with portfolio companies. Some cool things we talked about this episode: NIMBYism. I don't actually know what that meant before this episode, but not in my backyard is what that means, and how that's affecting projects and where projects are being developed. Capital formation and the long-term role of investors and capital in climate tech innovations. And like I mentioned, there's a couple cool things we talk about, like energy storage and other interesting ideas that people should be thinking about in 2025 about climate tech. All right, enjoy the episode. All right, Josh, welcome to the show. How are you?
Doing well. Thanks for having me.
Thank you for being here. We always talk about OGs, but you definitely are someone that we are excited to talk to. So this is a great pleasure.
Yeah, well, looking forward to the conversation.
Amazing. So we're going to start off with our favorite question, which is, if you could have dinner with any climate tech OG, who would it be and why?
That's a tough one, actually. There's a lot. I've had dinner with a lot of them, but there's always more. I think, one of the most successful companies out there, which some people, call climate tech and some don't, but is definitely a colorful character, is Tony Fadell, who started Nest.
Okay.
And I obviously know Matt Rogers reasonably well, but yeah, Tony's doing a lot of interesting work here and has a lot of stories of his own.
Yeah. Okay. Fair enough. It's always interesting to see who picks someone who's alive versus someone who's not. So it's good. That's a good answer.
It's easier to have dinner with the living ones.
Yeah. So we know who you are, but the audience doesn't. Please, who are you and what do you do?
So Josh Posamentier. I'm one of the co-founders and managing partners at Congruent Ventures. We're an early stage fund based in San Francisco, focused exclusively on climate tech writ large, all really focused on the early side of things. So our sweet spot is first money into companies all the way through kind of an early Series A. And then we support companies pretty actively throughout their life cycles. So that's us.
So to set the scene, how did you get from, especially for you, originally the semiconductor industry, now into climate tech? What was that journey?
Yeah, so I come from a pretty technical background, studied physics at Berkeley, originally spent first half of my career in semiconductors, everything from a deeply technical role early on through marketing, through general management, and then ultimately into venture a little bit. And I made the leap into pure climate focused investing after my last corporate role, which was running a group focused on energy storage and electric vehicles and smart grid in the semiconductor world. And so that's where I sort of learned that corner of the business. And then after that company was acquired, decided to really just focus in completely full-time on the climate space and really, look well beyond just the power and the semiconductor side of things. And in fact, I've only done sort of half a semiconductor deal in the last, 13, 14 years.
I feel like, especially when getting to read your profile, I feel like you're being a bit modest. You've done a lot of really great things. I'd love to dial back all the way, probably earlier than you were expecting, which is, when you were young and even thinking about the types of roles you want to take on, at some point you have to decide, okay, I want to do the risky thing, right? And get in some of this non-secure startup game, innovation game. And so what really do you think was the driving force personally behind that?
So let's see. I think some people are just constitutionally inclined to keep starting stuff. It's, call it professional ADHD or not. So ever since I was young, I've always really wanted to understand how the world worked, and that's what led me to physics originally. Is really understanding, how things are all put together, and really, from first principles to be able to understand how things work in general. Ironically, climate venture is the first time I've really gotten to use that academic background. Semiconductors, touched on it a little bit, but really that was a lot of vocational stuff. How to, architect chips and design stuff. This is the first time I've really gotten to really leverage that broadly. So it's kind of a coming home a little bit in terms of getting to use some of that academic stuff. But no, I really like to understand how things work, and in terms of the starting things, I've done this a few times. So I left a pretty comfortable job. Had about 10 years at Intel shortly after school, and left that to go start something. I was at Intel Capital, having a good time, looking at all sorts of stuff, and decided the grass was greener. Found out the hard way in 2007, 2008 that was not necessarily true.
Yeah.
Couldn't really have picked the worst time to try that, but learning experiences. So I've been on the other side of the table. I ended up not ultimately raising venture capital and bootstrapping that company before selling it. So I've got some perspective on what that's like, and so I think I've got a little sympathy. And then after ending up at my last venture fund, Prelude Ventures, post acquisition from the corporate world, it was really it was an incredibly educational experience. I mean, the venture is not a field for anyone who doesn't have sort of a learning, growth mindset and a desire to dig in and learn, because everything's different. Every time you turn around, there's something new and interesting and different you get to learn. And honestly, there's no better teacher than an entrepreneur who really wants to get funded. So fantastic teachers out there. And I've gotten to work with lots. I mean, over, between, we've done close to 60 deals out of Congruent. We have 50 active companies right now, and they are, they span the gamut from food to fusion. And I've gotten to dig into all sorts of crazy spaces, throughout that time. So just an absolutely fascinating experience.
Yeah. I mean, learning from the people who are solving the problems, that's how you find out what's broken, right? And what needs fixing.
Yep. I mean, these are the people that are out there identifying the gaps and bringing interesting technologies. Occasionally they have an interesting technology and they're looking for a solution. And the most fascinating companies oftentimes come from that space, especially the best entrepreneurs. Don't fire something up until they know where it's going to actually fit in the world. Yeah. So I think that's really exciting.
Before we get into the nitty gritty, I want to set the scene with, how did you come up with these? You said the grass was greener, and maybe you had, green colored glasses instead of rose colored glasses. Maybe that's not true, but, originally, how did you come up with the idea for your own fund, right? For Congruent Ventures.
So Congruent came out of a little bit of a process when I was at Prelude. So Prelude's a multi-stage fund. It's a very flexible platform. They can do anything from, early stage to late stage. And one of the challenges coming into there was on the early side. So this is 2011, 2012, when there was really a great falling out from the clean tech bubble that had burst, and a lot of funds hadn't raised follow-on funds. A lot of funds hadn't had left the climate sector altogether and refocused on general tech, and so there was a real hole in early stage climate investing, just not enough deal flow, and so that was a frustrating thing for us when I was at Prelude. And, over time, we worked on an internal seed program, and then ultimately started looking outside for other managers to support and partner with, and just really couldn't find a lot. And as I was landscaping that sector, it seemed like, more and more, it seemed like a really interesting opportunity. And, again, it's what you don't know going into these things that may have prevented you from doing it had you known. And so, no one, I don't think I'd never really talked to people who had started their own funds historically. And so I didn't, honestly know what I was getting into. I partnered with Abe Yokel, who was at Rockport at the time. And we, our funds had a bunch of deals in common. And so the two of us kind of got together and, hacked it out and figured it out, and both rolled out of our respective funds to kick off Congruent. ironically, our first close was supposed to be a couple of weeks after the 2016 election. Needless
Wow.
to say, that didn't happen for a couple more months as we, let the dust settle a little bit. But we've been investing in, now out of the Congruent platform for almost 8 years.
Yeah.
So yeah, it's been that. That's sort of the impetus for starting it, is really at the time rekindling the early stage climate space deal flow from an institutional perspective. There were a lot of angels, a lot of family offices, but very few dedicated venture funds really focused on early stage climate specifically. So that was the niche we really laser focused on, and honestly the one we're still in. I mean, we haven't really changed any part of that strategy since we started the firm.
Yeah. You dropped a nugget there that I'm going to have to ask about, which is the 2016, maybe 2017 vintage, right?
Mm-hmm.
Starting off in that cycle of all cycles. So, I think there could be some parallels to what what you saw then and what we're going to see in, like a 2025 vintage. So I'm wondering, are you seeing a lot of similarities between the two, just being, someone who now is even more connected with LPs than maybe you were at that point?
So the similarities were fewer similarities than you might think. So back in 2016, we just didn't know really what was going to happen. It was a total unknown. There was also no IRA, no infrastructure act. There was, very minimal support beyond, DOE funding and some existing programs, like existing ITC and PTC programs.
Yeah.
So there wasn't nearly as much to change, so to speak. I mean, LPO was pretty much dead at that point anyway. So authorized but dead. Now we've got the IRA with immense support for our sector. We have the infrastructure bill. We have the LPO is functioning and getting money out the door. There's once again we're going back into a season of flux where it's really uncertain what's actually going to happen. I just spent some time this afternoon on a call with some Republican policy experts who are again trying to rank order the likelihood that there will be negative effects on different aspects of the IRA.
Right.
And so there's a little bit of unknowns, a little bit of flux, but we've gone through our process to try to understand what in the portfolio is going to be negatively affected, what in the portfolio is going to be likely to be positively affected, and it's kind of balanced on both sides. So net we might be neutral, but now the big difference between last time and this time is now there's a lot that could be upended that could really sap the momentum of the sector. We don't expect it to, but
yeah. So just to make sure I understand. So if I was trying to look at some of the successes that led to what is a close in 2016, 2017 that still might have gotten some people over the line in what might have been an even more precarious time, it was the knowledge of what might be affected, but what might be okay, and it was that wherewithal that served you well. Do you think that is a similar strategy? Yeah. Yeah.
No, honestly, I think it was more the way that the thing that got us over the line with a lot of our LPs in 2016 was sort of our approach to climate. We were not and are not particularly dogmatic. Like, we are very mission oriented. Like, we very much like to fix and mitigate climate change and then, work on adaptation as needed. But we're doing it in a very, call it economically driven way. Almost all of our companies that are out there and operating make something cheaper, faster, more efficient for existing industries, and can, generally speaking, stand on their own 2 feet. So you're playing to strengths of economic strengths that are decoupled from government policy in most cases, not everything. I mean, we've got exposure like everybody else.
Yeah.
But generally speaking, if that's your investment thesis, you may be a climate fund, but that's not how you get underwritten. That's not how we benchmark ourselves.
Yeah.
It just happens that that's our area of expertise, and that's where we focus.
Got it.
We are intentional about it, just to be clear.
Okay. ClimateTech founders are taking on a huge challenge. Not only do they need to know how to build a startup, but they also need to deal with hardware, have a strong handle on climate policy, know how to fundraise from diverse investor types. It's a lot. That's why we made Clean Techies, the #1 podcast for climate tech entrepreneurs. In addition to our jobs, we devote 20 hours a week to producing this podcast for you. This way you can learn from the people who have walked the path before you, learn from their mistakes, and gain insights on navigating this complex journey. If this mission resonates with you, we are asking for your help. It takes a lot of effort and it's not free. If you are already a subscriber and want to help, start supporting us today by going to Substack and clicking Upgrade to Paid. Thanks for helping all the climate tech entrepreneurs like you.
Let's talk a little bit about Congruent itself. So you alluded to it at the beginning, saying you noticed this gap
in seed fund managers, people who are able to navigate the early stage, the universe of family offices and angels. So how does your investing model work? And, for the audience, for the clean techies out there, what's your focus areas?
So we are deliberately casting a really wide net across the climate landscape because, among other things, we consider ourselves successful if we deliver, top quartile venture returns. We don't do, we don't, I'm sure everyone says this, but we don't greenwash anything. We actually do, we actually go through a measurement process with every one of our companies as we try to quantify their current or potential impacts of their, pre-product, pre-revenue. So everything in the portfolio is very clearly and directly and materially measurably green or climate friendly. The way we think about sectors is both vertically and horizontally. So horizontally, we look at software, hardware, fintech, frontier tech, deep tech, whatever you want to call it, insure tech. On the vertical side, we sort of divide the world as best we can into 4 verticals. We have energy and energy transition, pretty self-explanatory. And that's everything from generation to grid technology to make the grid more robust and resilient and able to absorb more renewables. We do food and agriculture. Obviously, there's a growing global population that wants to eat better and better and eat more and more protein, and we have to feed more people with an ever shrinking per capita arable land number. So you need to increase the output of the land while hopefully decreasing the inputs and reducing the footprint. And again, that's almost always economically beneficial to the growers, the farmers, and the people eating the food. So usually that's a win-win-win. We have urban and mobility, which is, again, everything from the built environment to how we move people and goods around. Efficiency. It's all efficiency and utilization and waste reduction, and circularity actually falls into our last bucket. Our last bucket is sustainable production and consumption. This is manufacturing tech. This is where carbon capture, circularity, that sort of thing falls into. But also other things like advanced manufacturing technologies, metal fabrication. Again, these are often focused on waste reduction, build it just in time type technologies, or software that runs factories more efficiently. So it's a very broad 4 sectors. There's little that doesn't fall into one of those, but that's kind of how we draw the picture.
For all the clean techies listening, I would highly recommend going to Congruent's website. There's a very cool graphic that can probably put into context something that you're saying. I had a lot of fun looking at it leading up to this episode, but it really does clearly illustrate how you are broad, but you are specific in how you are broad, in that the pockets where you're willing to look at companies and invest, likely driven by that. One question I wanted to ask, this is, we're putting you on the spot here, but there's always some confusion and some difficulty in measuring and trying to understand what is real tangible impact. So without giving an answer potentially to an unanswerable question, where do you see the most friction in your portfolio, generally speaking, when it comes to measuring? Are you finding that there are areas in your portfolio that you often find more confusion when it comes to verifying the carbon impact?
So we ask a couple of things. So being an early stage venture shop is a little bit different than being, say, a growth stage shop. So many of our companies, I'd say the most friction comes from, situations where we're asking for something, they are, either not capable of measuring yet because it's a, understaffed team, or they haven't actually gotten a product into market yet, or it's something with very diffuse benefits, which if you take a step back, you're like, oh, there's no question that this has an impact in a lot of different dimensions. I would highlight, we have a company in the grid space that does software to manage and run grids. It explicitly makes it a lot easier for those grids running their software to absorb more intermittent renewables without adding cost and additional hardware to the network, because it leverages existing assets to orchestrate those intermittent loads more dynamically than an existing EMS software tool. So there's no question that it's climate friendly and helps drive more renewable penetration, but it's grid operation software. What's the direct impact of that? That's hard to measure. So we do our best to try to suss that out. We partner with our companies to figure out what to measure, how to measure it literally on an annual basis. And so, sometimes it's a little bit of a guess. We're not going to get hung up on that. We don't have a hurdle. We don't have an X gigatons per year by some date, or even at the portfolio level. We just want to make sure every company is measurably and materially, climate friendly and climate first. So sometimes it's a subjective measurement until companies get to a certain degree of maturity. And we don't even mandate they report anything, they'll most voluntarily do until they're at 20 plus million in revenue.
Yeah. But it is comforting to hear that, even after all the boards that you've been on, all the companies you've seen, you still are able to kind of navigate. That's how you navigate, the metrics at the early stage.
Yeah.
Um,
Yeah. I mean, there's false precision is kind of useless. Like there's
yeah,
no reason to do that. So,
got it.
I mean, when people ask us for the carbon impact of a company that is pre-revenue, that's obviously a meaningless number.
Yeah,
Their carbon impact we try to measure as well,
yeah,
also meaningless number.
yeah,
So, you know, there's no point to that. So what we try to do is say, look, at scale, what's this going to actually mean? Is this going to move the needle somewhere, or is this kind of pointless from a climate perspective?
yeah. Well, I appreciate being a good sport about that question. Moving on to something maybe a little bit more fun. I think one of the things that's starting to echo throughout how you speak, and something that I used to be in venture, one that invested at seed and Series A, but had very great relationships up to the B and C. So you kind of saw how the exposure to later stage investing, like you said, maybe a growth shopper,
Mm-hmm.
yeah, something that invests at a later stage, gave you some more perspective, not only in the relationships that you could bring to the table when you're investing in a company, but also in how you looked at investments in terms of their exit strategy, in terms of the next round, and how you navigated those dynamics. So you, as someone who is investing in climate but has some experience also looking later stage, how do you feel as though that really complements your investing strategy today?
So I think one of the things that tends to make climate companies, and probably all companies, more successful over time is capital formation. I mean, that is part of our core initial underwrite, is thinking through the capital formation process, the value accretion, stages. If you look at, and I wish there was something like this for climate, but if you look at pharma and biotech companies, there are very clear value creation stages along the way. That's very crystal clear. It's like, oh, you've passed this trial, that trial, this metric. The company's worth this. Now it's worth this. It's a lot fuzzier in climate, and so we try to help companies think through at our initial investment. Okay, what are the key milestones that are going to create value and de-risk the technology and get you well funded for the next round? And we do this like several steps in advance as much as possible. And so helping companies think through that, I think there's a lot of seed stage investors that just don't have that perspective. They're just like, I get my first mark and off I go and refocus to a different company. We tend to stay focused and engage with our companies almost indefinitely. I mean, we've stayed on the boards of companies through Series D, D2s, and that's again pretty unusual for a seed fund. And it's partly because I'm hoping, others can attest to this, that we've established trust and value add. I mean, as cliche as that is, but we try.
Yeah.
We try very hard.
I'm sure, some diligence on the founders would reveal that it's been pretty helpful. I can imagine they're happy their VC didn't leave after one round, right? So,
I mean, that's not. I mean, that's more normal than not for seed stage investors.
yeah, exactly. So, I think one of the things I'm also curious about is not only the context of what you said, but you started talking a little bit about, other managers you might see in climate and how they go about interacting with their investments.
Mhm.
So I'm wondering, starting all the way in sort of the 2016 vintage, 2017 to now, how do you feel like early stage, people you co-invest in, maybe even the expectations that founders have going into, getting an investment from you? How do you feel like the relationship between founder and investor has changed over the journey of, clean tech to climate tech? Is there anything that you feel like has changed over time?
Not tremendously, honestly. The work is the same. I think the value add is maybe a little bit different, especially as maybe capital has been tightening a little bit in the last little while. So having a lead investor or a support investor with a good reputation and good relationships with later stage funds, that can be materially helpful. But I mean, that's not tremendously different. Obviously, the world was a different place in the ZERP era. 2021, early 22. I mean, it was a very different fundraising environment. You potentially needed your investors a lot less, your early stage ones. I think now people are leaning on them a little bit more. I mean, I'm glad we have a very robust reserve strategy, but yeah, I mean, it's cyclic. This whole industry is super cyclic. So, this is probably going back to where things were
Right.
10 years ago.
Right. I'd love to go into our first segment, piggybacking now off of that, which is not even rewinding the clock to CleanTech 1.0, but also talking about now the semiconductor industry. So
Mhm.
this is more of a me for me segment. I'm a huge fan about the history of venture. I've studied it a lot, read a couple of books on it, and obviously the start of venture in the 1960s was Fairchild Semiconductor, and so
Mhm. And
semis obviously have
Intel. Yep.
yeah very yep a very special place in that. So you know I think one of the really interesting parallels that has been discussed from time and time again is that if you think about venture and the argument that venture is not a good fit for climate tech, obviously software is, a good fit for venture, but that doesn't mean that hardware investments don't necessarily work, because if you look at the origin of venture, the very first venture style investment was a semiconductor hardware technology.
Mhm.
So, maybe trying to create a story out of something that's not, is there anything about how you worked with hardware early on in your experience that informs how you look at hardware today?
Uh, yes, I think it's pretty challenging to invest in hardware companies if you don't have some appreciation for what it takes to build a hardware company or a hardware business. And semiconductors are a pretty good paradigm for how that
Yeah.
works. I mean, it's almost the worst in some ways of that world. It's incredibly long design lead times, very low tolerance for screw ups because turn times in a fab are long and painful, and so you really try to get it right the first time. You can't just keep dropping, you can't just keep pushing code to GitHub, on an hourly basis and hit go. It just isn't the same. And so there's the course correction, the theory of operation, the insistence on really being clear with your customer discovery about what you're building, just super, super critical. I think I obviously am a huge disagreeer of people who think venture is not a good fit for climate tech, but venture is one tool in a big old toolbox. It is not the biggest tool by a long shot in terms of actually getting stuff built and deployed, but it's a critical tool. That being said, venture is really good for a few things. I mean, this is, for any student of venture, venture capital is meant as an investment tool in sectors where linear linear deployment of dollars results in nonlinear exponential, hopefully, deployment of or receipt of revenues. You want those things to scale really nonlinearly, and if you have there's a whole class of businesses that are incredibly good businesses, very profitable, but they scale linearly. You put in X dollars, you get 2X dollars back. That's fine. That's a consultancy. That's a services business. That's a lot of other kinds of businesses. That is not a great fit for venture when you're looking for the kind of IRRs we're looking for and the kind of MOICs we're looking for. So that is, so mapping that onto climate, there's a lot of really incredibly impactful sectors that we've been challenged to figure out how to invest in because of those dynamics. They're either commodity businesses that are natively low margin, and there's, barring an incredible breakthrough, it's hard to imagine how a venture funded business is going to get there. There's other businesses where it might be a great fit for a mega fund that are tough bits for a seed stage fund. We don't, you businesses that take too many dollars of capital to get to a proof of unit economics are challenging for a small fund. It might be fine if you look at not necessarily exactly the canonical example I would look for, but if you look at what GC Lightspeed and others did for Pacific Fusion, they put together a $900 million sort of package that's going to deploy over who knows a decade plus based on technical milestones, and that's probably not a good fit for Congruent. I mean, we're an early stage fund. It'd be hard. We'd be hard pressed to get anywhere close to any of our ownership targets for whatever funds, whatever check size we could deploy. So that there's other things, out of Clean Tech 1.0, I could point to a lot of biofuel deals where you didn't know if you kind of knew the tech worked at the bench, but until you built an actual plant, you didn't know what the unit economics were actually going to be. And so that's a structural challenge for those of us running small funds or potentially the entire sector.
Yeah,
So
getting a little bit, nerdy about the numbers to follow up on what you said. So when you talk about equity percentage, I think that's something that is a real nuance that people don't think about. A lot of founders don't really think about. But once you enter the world of what is, seed and A investing, like this is critical, right? How do you model your investment and how do you get return from it? So I'm curious, the adage, especially from my experiences, a fund that leads cares about somewhere around 10%. It can change, depending on your investing style and what you expect from the future, but that was the marker. Do you look at, your equity percentage from a very rigid point of view, or what are the things you take into account when thinking about how you go about that?
a lot of renewables are physically large. They take a lot of land area. And so people can see them. People can see the giant wind turbines. Assuming Chris Wright gets confirmed, oh yeah, He's a huge energy guy. He's a pragmatic energy guy. He's like, let's do the thing that makes sense. At the end of the day, they're an awesome company that knows how to drill really well, with keep the cost down, engineer good reservoir, performance. But is there anything preventing?
Thanks for listening so far. To get the full episode, go over to Substack and become a Clean Techies premium member by selecting any paid membership. Not only will you get access to hear the rest of this episode, but you'll get access to exclusive interviews, our monthly show, the best, most relevant insights from our shows, and access to our premium community.